So thank you everybody for joining us on Monday morning to talk about PPP. Hope everyone had a nice weekend. Thank you to MSADA for referencing this out. I know some of the auto dealers are in here as well. So we just wanted to put on a quick webinar just to kind of, as the title says, check in on PPP forgiveness. We're at a point now where we're starting to see the lenders are getting comfortable with their portals. We've had some borrowers that have submitted for forgiveness. The SBA had been able to accept applications late in the summer or late in August, but some of the lenders had been holding off on doing so despite that, just to kind of, get all the cobwebs shaken off and get their processes ready. There's still some uncertainty surrounding the PPP program. There'll still be more FAQs and probably regulations and information like that that'll continue to trickle out over time. Besides the related party rent rule that recently came in, which was a little bit of a curveball, we expect that most of the new changes will be borrower friendly. So it's kind of in a spot where if you think you're already getting 100% forgiveness under the current rules, with the exception of the new rent rule that came out, you should generally be able to retain that 100% forgiveness going forward under the rules that come out. That being said, don't know exactly what'll happen in the future, but that's the way it seems to be moving. If nothing else, you can start to get in a position where you're gathering your information, whether you self-review or you have your accountant or professional review the information. Even if you're at a point where you don't necessarily want to submit your application to the lender quite yet, just getting everything to the point where the application's filled out and all your information is gathered, this is probably a good time to start doing so. I did also want to mention that at the bottom of the screen there should be a Q&A section. We might have some time at the end of the presentation to answer a few questions, but otherwise feel free, if there's something that's not covered in the presentation, drop something in the Q&A there. We should be able to reach out and get back to you. Or also a few of our contacts will be listed at the end of the webinar if you want to email us directly with your questions. All right. So just a quick disclaimer on it, everybody's business is different. You just want to look at the specific facts and circumstances surrounding your loan and your business before you make any calls. Discuss with your tax professional, attorney, business advisor, anyone before making a decision. But today we're going to go over just an overview recap of very quick recap of the PPP program. Some key item reminders that'll help you as you're going into forgiveness, applying for forgiveness. There are a couple open questions, and there's been some legislation floating around, which it doesn't look like it's going to be passing anytime soon. I guess crazier things have happened, and then resources just for you want to reach out and contact us as well. So just a recap, this is almost just to have for reference the legislation background on it. Everybody knows back in March, CARES Act introduced the PPP. That gave it about $350 billion of funding. There's about another 300 added, so we ended up around $650 billion of funding. In June, we got the Flexibility Act, which generally had borrower-friendly changes. That gave the 24-week covered period. Also, if you took a loan out after June 5th, you had 5 years to repay the loan instead of the original 2-year term. That term could also be extended upon mutual agreement between the borrower and the lender, changes like that. And then there was also another piece of legislation at the beginning of July that pushed out the application until early August. So at this point, even though not all the funds were used, I think it was somewhere around 150 billion or so that was left over, you still can't apply at this time. Those funds may eventually get rolled into what will end up being a second round of PPP if that ends up happening, and maybe reappropriated, something like that. The PPP itself, if you're here discussing forgiveness, I'm sure you probably know how it works, but you essentially got 2.5 months worth of your 2019 payroll. You could spend that loan on certain expenses, being payroll costs, mortgage interest, rent, and utilities. There were some other expenses as well, but if you wanted your expenses to be forgiven, those were the key items. The amount spent during the covered period, being your 8-week or your 24-week period, would be forgiven and don't have to be repaid to the lender. So this is why the loans, essentially, people look at it almost like a grant. And then loan forgiveness can be reduced by if you reduce your the actual pay rate for any employees by more than 25% during the covered period, or if your FTE count, your average full-time equivalency, during the covered period, as measured against some prior reference periods, drops. That first one about the salary and hourly pay rate, that one is not as much of an item anymore, because the SBA did come out and clarify that and we'll get into it as well, but if there's a reduction in the amount of pay for an employee associated with a decrease in the amount of hours for the employee, as long as their actual rate was staying the same, you won't get hurt on that number one, the salary rate piece. It could potentially reduce your FTE count, but you won't get hit on the pay side. So that stops people from getting hit twice on the same issue. So one of the key items to consider is non-deductible PPP expenses. So right now, as it stands, when your PPP loan is forgiven, it's not taxable income. You're not taxed on that. However, the IRS has come out and said that via Notice 2020-32, that expenses paid with funds that are subsequently forgiven are non-deductible. So in other words, you don't have to pick up the proceeds in income, but you can't deduct the expenses that you paid, the wages, the rent, utilities, etc., after the loan has been forgiven. So it ends up essentially, it kind of creates a wash there. You think you have the benefit of not including it in income, but now all your deductions are gone. So where does this stand? Because when this came out, people were thinking, this was a nice benefit. Not only did you not have to pick it up in income, you could deduct the expenses. Some people were calling it a double benefit per se. So after the IRS came and said that those expenses would not be deductible, there have been efforts in Congress to restore the deductibility of expenses. There's been a series of letters from different members saying that this wasn't the intent of Congress and that the intent was to allow the expenses to be forgiven. There were some lawmakers that were saying, if it was the intent of Congress, then it would have been explicitly laid out within the legislation. But for something like the CARES Act, where it was such a massive piece of law that was thrown together in such a short period of time, to anticipate that there would be no technical corrections necessary, I think that would be a hard call. So at this point, the expenses are still not deductible, but there's a bill 3612 that's continuing to get co-sponsors. It looks like every couple weeks or so, there's more co-sponsors of the bill. One of the versions of this was in one of the earlier, I believe it was in one of the earlier, stimulus 4 legislation packages in July, August. They've since, come out with some skinny bill versions of the next stimulus legislation, which has not included the restoration of the expenses. But at this point, I'm hopeful that we'll eventually get it. Part of it is unfortunately the timing with we have the election coming up in November. There was an attempt to pass a small, again, skinny bill last week that didn't even get through the Senate, never mind the House. So we might be looking at something where, we'll have the continuing resolution to keep the government open at the end of September, and we might not see any material legislation pass until after the election. If they could do it before then, that would be great, so that we don't have to keep waiting on. I know a lot of people are doing their quarterly estimated taxes, and it's hard to measure. Do you consider those expenses deductible or not? And then hand in hand with that, if, as this last bullet mentions, if you're incurring and spending the expenses in one year and then you get the loan forgiven in another year, what exactly is the treatment? We don't have it necessarily confirmed. I think there's definitely different opinions out there. I think some people are going to just take the expenses. I think some people see it as those expenses are non-deductible when the loan is forgiven. So there's a strategy, I guess you could call it, of waiting until 2021 to actually submit the loan forgiveness. Thus allowing you to deduct the expenses in 2020, and then in 21, then you would pick up like an add back of those expenses into your income. We don't know for sure, whether or not that's the case, or if it's, if there's an intent to get forgiveness, are you then required to add back the expenses on your 2020 return, that kind of thing. It's something that we're just kind of monitoring at this point. For the fiscal year filers, I know we get some, there's some of the June 30th ones or September 30th, maybe running into this now. I'd say, just continue to extend the returns out until we get some more guidance on this. I think, it's kind of hard to make the move on it. And instead of having to incur the extra cost to do an amended return on the off chance that you picked the wrong side of the coin, extend the returns. I mean, it shouldn't stop you from, you can still get your information in and start to get all the information together to put those, to get them ready to be sent out. But consider holding off on the actual submission until we know what's going to happen with those expenses. They're going to have to tell us eventually. Another one, so this is one of the bigger pieces of guidance that's come out recently, is they finally spoke on related party rents. So the question was out there, if I'm paying, a lot of businesses have an entity structure where one business is the actual operating entity and another, and maybe an LLC or something, holds the actual real estate that the business operates out of, for legal, other reasons. So there was a question of, if there is common ownership between those entities, can you be deducting that rent expense? So they've come out and they've said rent paid to related parties is only forgivable to the extent of mortgage interest owed on the rental property during the covered period for related parties. Related parties here is just defined in the guidance, it's just defined as any common ownership. So 1%, if someone that owns the dealership has 1% in the LLC that owns the property, presumably under this definition, you fall into this related party rents situation. So there's an example here. I'll just run through this quick, but I think it's pretty clear as to what they're looking to do is, had the operating entity owned the property, you would have only been able to get a forgivable expense to the extent of the mortgage interest. So they're kind of looking through to the related party and applying that same rule. So borrower company is a PPP borrower operating out of facility owned by Real Estate LLC. Borrower and real estate share common ownership, so that makes them related parties. So during the covered period, borrower co makes 2 months worth of rent, $50,000 each, totaling $100,000. And during the same time, Real Estate LLC incurs $20,000 mortgage interest for each of the 2 months, totaling $40,000. So you got $100,000 of rent expense, but on the related party property, you only had $40,000 of mortgage interest. So in this case, the borrower may only request loan forgiveness up to that $40,000, the lesser of the rent paid and the mortgage interest owed. If instead the facility owned by Real Estate LLC was not subject to any debt, there was no mortgage interest incurred, then you would not be able to deduct any of the rent payment to the related party. So for borrowers that had originally been planning on using the 8-week period, that had been leaning on related party rents as one of the bigger forgiveness pieces, this kind of came as a bit of an unpleasant surprise, because now maybe where you thought you spent all of your proceeds on forgivable costs, now you've been limited by the amount of mortgage interest on the related property. Fortunately, anyone that took out the loan, whether it was before or after the June 5th PPP Flexibility Act, you're allowed to use the 24-week covered period. So the idea here is, say even to the extent, maybe that last line, maybe the property doesn't have any debt and you can't deduct any of the rent paid to related party. Consider switching from the 8-week covered period to the 24-week covered period, because you should generally be able to use up your full loan proceeds just on payroll alone over the 24-week covered period. And on top of that, it kind of simplifies the application process too, in that when you go to apply, if you're using strictly payroll costs and you don't have to substantiate the rents, and you don't have to substantiate the utility costs, mortgage interest, etc. Some of the payroll processing companies now have PPP reports as well. So it could be something as easy as you spend all the money on payroll costs during your covered period, you run a report in your ADP or your paychecks or whatever you use that backs up to that same number that shows the amount of FTE you have, and there you go. That's covers all your costs. So if you do have the related party situation, maybe reevaluate that, just see if that's going to hurt you at all. If you were using an 8-week, consider switching to the 24. And if not, if maybe there was enough mortgage interest that you can still use those rents, and you still want to squeeze it into an 8-week period or use it up in the 24, you can do that as well. But they did make that rule change, and again, that's kind of the exception where we expected most changes to be borrower friendly going forward. This one was kind of against the borrower, and it would have been great to know this, as with a lot of the guidance earlier on. Loans greater than 2 million subject to audit. So this isn't exactly something per se set in stone, but the Treasury Secretary Mnuchin has come out recently and signaled that all PPP loans greater than 2 million will go through an individual audit, as he calls it. The specifics of the audit aren't, again, because this hasn't come out and it's, there's no official guidance release to support what he has said in the last week or two. I think a big piece of this would be looking at, whether the borrower was whether it was correct for them to actually take a loan at that time, for example. But we don't have the specifics of what those audits would be at this time. It could be influenced by the media stories. We've seen some of the high-profile fraud cases. We saw one of the athletes last week took out a PPP loan, spent it on who knows what. So stuff like that. We've seen public perception kind of mold the PPP program in the short term in the past, so it might be something like that in the future as well. There is a checkbox on the application for 2 million or more for the amount of your loan. So that's kind of a red flag for them. If that box is checked, then they're probably pulling that application into the audit pool. So just something to consider is, for our dealerships out there, if you are a franchise dealership, it's been and most franchisors have been assigned a franchise identifier code. We do have a link at the end of the presentation if you want to double check. But if you're a franchise dealership that's been assigned one of these codes, you're waived from applying the affiliation rules. And those affiliation rules would have made you have to combine the amount of loans and combine all the information from multiple franchise dealerships together. But you're accepted from doing that. So in a simple example, 2 franchise dealerships with these FIC codes, each with a loan of 1.5 million. Maybe there's common ownership between those, common in the way they operate. You would typically think you have to combine those and look at it as a $3 million PPP loan, but because of the franchise exception, neither of the dealerships will have to combine. They're each considered to have a $1.5 million loan, and it would not be advised to check that box to prompt an audit. So again, that's just something to think on if you have, multiple locations where each one by themselves are under that 2 million. If you have that franchise identifier code, which again most have at this point, then you'll want to avoid checking that box if possible. You just don't want to give them a reason to look at your application any more than they have to, I guess you could say. All right, so then now getting kind of into, just reminders, just looking at the safe harbors and the exemptions. These haven't really changed over the last couple of months, but they're good to know, good to keep fresh in your mind as you're going through the application process. So remember, the first of the 2 ways that your loan forgiveness can be reduced is if you cut any employee's pay by more than 25%, specifically their pay rate by more than 25% during the covered period, as compared to pre-COVID. If that did happen, which we're finding most borrowers haven't had to do that, there is a safe harbor where if you had a decrease in the annual or hourly rates between February and April 20, and then you're able to restore the rates to where they were at February 15th by the earlier of December 31st, or when you apply for the loan, meaning, say you had a decrease in, you had to cut the wage rate of employees by 50% so that you could sustain, get through, April, May, it started to pick back up. If that would otherwise reduce the amount of loan forgiveness you have, you can look to the safe harbor. You say, what were the rates at in February? What are the rates at now? And you want to just restore those to those February 15th levels. If you were to, apply today, you would want to have them restored by today. If you're going to be applying after year end, you want to restore those by at least December 31st. So that's the salary wage reduction safe harbor. On the FTE side, which is probably what most people will be dealing with, first, there's some exceptions to keep in mind. So your FTE count is not reduced for any positions where you made an offer back to the employee, which was rejected by the employee. You are supposed to notify state unemployment offices within 30 days in order to utilize that exception. There's also exceptions for employees that were fired for cause, voluntarily resigned, or requested and received a reduction of hours. And what these exceptions would be is, if you had 20 employees in the original period and now you got 19, and someone was fired for cause during the covered period that brought you to 19, you're not going to get dinged for that. There's an exception. You get to essentially add back that one count. So you're treated as having 20 during the covered period because that exception applies for the decrease in the employee. So if you do have anything there where someone's left for certain reasons, you might be able to avoid having to do a rehire or avoid having any loan forgiveness impacted by that. The FTE reduction safe harbor, this one's pretty similar to the salary wage reduction one that we were just talking about before. So if your FTE decreased between February and April, and then you can restore your FTEs by the earlier of when you apply, or December 31st, to where they were on February 15th, then the FTE reduction does not apply to your loan application, and you won't have your forgiveness reduced. So again, you see an FTE reduction, you say, okay, where was I February 15th? I'm going to apply for the loan now. I want to have my FTEs at least up to this level, either if I'm applying today or if I'm applying next year, then by December 31st. Additionally, there's also, I guess you can kind of call it a safe harbor that was built into the application itself, where if a borrower has not reduced the number of employees or average paid hours of their employees between January 1st and the end of the covered period, they're also considered to be the safe harbor and would not be hurt on the FTE. And then another FTE, I consider it FTE safe harbor, is the, I call it COVID safety guideline FTE safe harbor. I'm just going to read off this first paragraph. I know there's a little bit of substance to it, but it's a pretty valuable exception or safe harbor if you are able to utilize it. So it says, the borrower is unable to operate between February 15th and end of the covered period at the same level of business activity as before February 15th due to compliance with requirements established or guidance issued between March and December by the Secretary of Health and Human Services, the CDC, or OSHA, related to the maintenance of standards of sanitation, social distancing, or other work or customer safety requirement related to COVID-19. So what does that mean? So basically it's saying there is a safe harbor that applies if you were impacted by, most states were in a position where because of federal guidelines, maybe something came down at the state level that said, non-essential businesses must close, or you must limit the capacity, or you have to make these kind of accommodations for sanitation or social distancing. And if because of those requirements, you weren't able to operate at the same level of business, you weren't able to get your FTEs up because of that, the idea is that you get a safe harbor and you get a pass on that. Now, it does seem a bit vague. I'll show you on the next slide. There was one example in the regulations on this. I think it's kind of an opinion right now as to how liberally you can apply this safe harbor. Just to continue on with it, you can certify in good faith. So basically, when you look at the application, it's kind of like you're checking the box. They ask you to retain for your records, relevant financial records, and if there were any guidelines issued by the state or federal that impacted your business, to retain those records. But substantially, all you're doing on the application when you're using the safe harbor is checking the box and saying this applied to me. And because of how, I wouldn't, maybe not as far as saying ambiguous, but because it's not that narrow in scope, the intent seems to be that when they introduced this safe harbor, they said, look, you have your FTE before COVID happened. We want you to maintain the FTE during the covered period. If you can't maintain the FTEs during the covered period, then we'll let you restore it up until December 31st. And then if you still can't get there by December 31st, and it's because of all these safety guidelines and everything going on with COVID-19, then we'll give you a pass on this. And that's why when I look at the forgiveness process now, I largely look at it as, unless you're in a position where you found, okay, we were operating at a point where we had so much staff and we don't have any intent to get back to that level, not only because of COVID-19, but, just we found that we didn't need it for operations. In that instance, you might be subject to a repayment, although some may still argue that you could rely on the safe harbor. So that's where it kind of gets a little murky in how it can be applied. But I think the idea is for employers that were trying to restore the FTE, and for whatever reason they couldn't because of COVID-19, the government's trying to give you a pass there and not have your forgiveness impacted by this. So the example from the regulations, we'll have the slides available so you can read it in more detail, but it talks about a business where in March they were required to shut down their stores, and then it says because the borrower's business activity was reduced compared to prior to February 15th, they satisfy this exemption, and the forgiveness amount of the loan will not be reduced because of a reduction in FTEs. So this is definitely something to consider. This is probably one where if you feel like you're on the fence with this, maybe consult with your business advisor as to whether or not you want to lean on this safe harbor if you don't think you're going to get back to, your regular levels by December 31st. Okay, I know we are inching close to 11:30. There's not too much left. We will have this, if anyone does have to go, we will have the slides available on our website as well. Applying for forgiveness. So the SBA platform opened up for lender submission on August 10th. This is what I meant where, back mid-August, lenders were able to submit to the SBA, but most of the lenders were still getting their portals up and running, getting checklists, different means of applying ready for the borrowers. So at this point, I'd largely advise, if you haven't already been emailed by your lender and you're looking to apply for forgiveness, reach out to a representative from your lender to see if their portal or whatever means they're using is now available and open for you. We've seen probably in the last 2 weeks or so, a lot more rolling out. So many of these are available now. The lender has 60 days to review forgiveness application, and then from the point the lender submits, the SBA has 90 days to make a determination. I've seen in a few cases so far, we had someone that applied through their bank portal, and within, I think it was 2 days, they got an email back saying, congratulations, we reviewed your loan and it's been submitted to the SBA. So maybe the first round of review through the lender is going to be moving fast. Maybe that lender didn't have many applications in its queue. It's going to probably be different for each size lender, each different scenario. And there's not necessarily a rush to apply. Building off that, the reason there's not much of a rush to apply is, whereas there originally was a 6-month deferral for repayment, the Flexibility Act back in June changed the deferral to the earlier of when the loan forgiveness is remitted to the lender by the SBA. So if the lender reviews the loan, SBA reviews the loan, they say you're good for forgiveness, and they send the money back to the lender. If you have any loan left over after forgiveness, if it wasn't 100%, that's the point when you would start repayment. Alternatively, if you don't apply by 10 months after your covered period, the lender will also start looking for payment at that point. So what this means is you essentially have 10 months from the end of your covered period to apply for forgiveness before the payments will start. So for people that are using the 24-week covered period, maybe that's taking you into September, October, depending on when you get the loan, you could potentially have 10 months from then to apply. I mean, you're looking at the first quarter, second quarter of 2021. So again, there's not a huge rush to apply. And because of that, the non-deductible PPP expenses question that we were talking about earlier, as to if you apply in 21, maybe you can take the expenses in 20. That's where we're seeing some borrowers are, they're getting all their information in, they're filling out an application, they're having it reviewed internally or through their business advisor, and then they're just kind of sitting at the goal line and they're waiting to actually take that step to give it to the lender. So I'd say there's no harm at this point in starting to get ready for forgiveness, to measure where you're at, to see if you're able to get the 100% now. And then it's up to you to weigh, whether, I don't care whether or not they change deductibility or what else is coming down the pipe. I just want this thing out of my life and forgiven, and you submit it to the lender. Or if you want to, get to that point and hold it and wait to see what other changes come out. But you do have some leeway in the time. It's not, you're not right up against the wall right now to do this. For the actual forgiveness forms, you're looking at the 3508 and 3508EZ, both of which we have linked at the end of the presentation along with the instructions. Essentially, the 3508 is the original long form forgiveness that we saw where you might have a reduction in pay rate or FTE, which could potentially reduce your forgiveness. And the easy is generally for borrowers without forgiveness reductions or self-employed borrowers. So again, 3508 EZ, for self-employed borrower with no employees, you can use it. And then if you did not reduce the annual salary or hourly wages by more than 25%, and you either didn't reduce the number of employees or average hours paid between January 1st and the end of your covered period, or you want to rely on that COVID-19 safe harbor exemption that I was talking about previously. So again, 3508 EZ, you didn't reduce the wages, you didn't reduce the hours, or you did reduce the hours, but it's because of COVID and you plan on checking that box. Then you can use the 3508 EZ form, has less schedules, a little bit quicker to prepare. But we have seen some lender checklists that have even said, even if you're completing the 3508 EZ, please provide the documentation necessary, or that would be necessary under the 3508. So that's, again, something where I'd say look to your lender portal, see what kind of information they're looking for, see if they explicitly allow you to choose between the EZ and the non-EZ before you spend too much time seeing if you can qualify for it. But if you were going straight off the form, it is definitely easier, as it says by name. Information gathering. I won't run through all these out loud, but on the forgiveness application, it lists the different documentation you want to have for your payroll costs, full-time equivalents, and your non-payroll costs. You can take a look at these, or you can take a look at the application instructions for the information they're looking for. You want to retain this. There's some different figures out there, but at the bottom of the application instructions, it mentions retaining for at least 6 years. Most of the documentation required to submit for the loan and to apply for forgiveness. So I would say the safe bet would be all the information you put together, whether it's stuff you've already used to apply for the loan, or if it's the information you're using to substantiate your forgiveness, keep that on record for at least 6 years after the loan's forgiven or repaid. And, just in case they do come knocking, it's obviously better to have it in the file somewhere instead of having to recreate the wheel X years down the road from then. Open questions and pending legislation. So one of the open questions is if you apply before the end of the 24-week covered period, SBA hasn't explicitly given guidance on how the FTE reduction would be calculated. So what I mean here is if you spend, say you offer a 24-week covered period, but you've spent all your money by week 14, you can apply for forgiveness. And the SBA has given guidance on how that pay rate reduction, how that works. You essentially have to calculate it and expand it over the 24-week period. But there's nothing explicitly laying out how the FTE reduction works. Right now, I've seen it, if someone applies on week 14, you calculate your FTE, your average FTE over the 14-week period. You can't calculate out 24 weeks if the 24 weeks haven't happened yet. And they have said that you can apply before the covered period ends. So presumably that's the way to do it. I don't foresee that in review they come back and say, okay, well, you apply based on this average FTE figure, and now we have to see if you kept up that same average between week 14 and week 24. I guess it's possible, but it seems like that would be a burden on both those reviewing and the borrowers themselves. So that's just something to consider if you do apply early. As we mentioned, how liberally to apply the exemption related to COVID compliance guidelines, kind of a facts situation. The handling of the non-deductible PPP expenses, whether you want to, rely on that applying in a different year, or if it's a non-factor for you, you'd rather just pick it up in income in 2020, call it a day. And then we also have the question still of whether floor plan interest meets the definition of mortgage interest for the purposes of this program. Kind of like when we were talking about with the rents, if now you couldn't get loan forgiveness using an 8-week period by including your rent, now you're just going to use 24 weeks and use payroll costs exclusively. Similar thing here. If you were originally going to use floor plan interest and you think, it's still on the fence as to whether or not that'll qualify, maybe just leave the floor plan interest out entirely and just rely on your payroll costs for the full 24-week period, or however long it takes for you to spend the funds. Possible changes from stimulus legislation. So most of these come from the bill that was actually, they tried to vote on it last week, but did not get through the Senate. So there's an expansion of, well, first of all, there's been mention, of course, of making the PPP expenses deductible. I don't believe that was in last week's, but I think they're of course still advocating for that. There's simplified application procedures where there's essentially an automatic forgiveness for loans under 150,000. I think there's still a form to fill out, but it's pretty much self-certification for all aspects of the application. There's also a proposed reduced documentation for loans under 2 million, where all those like the payroll registers and the receipts for your non-payroll costs, you would still retain those for your records, but not necessarily include those with your forgiveness application submission. Some flexibility with moving the covered period, and expanded use of the PPP proceeds to use on personal protective equipment, some operating expenses, property damage not covered by insurance, items like that. There's also mention of a second round of PPP loans, a second draw for borrowers, smaller borrowers with 300 or less employees. The original one was generally 500 or less employees. So the second one would be 300 or less. That can show a 35% or more decline in revenues. I believe it was as compared to first quarter and second quarter of 19 versus second quarter or first quarter and second quarter of 20. Whether that moves based on when the legislation passes, we would have to see. And then there was also mention earlier in summer on allowing PPP borrowers to retroactively claim the employee retention credit. This is a credit that's not available for borrowers that have taken out the PPP currently, but it lets you take a payroll tax credit for the first X amount of wages paid to employees. So what this would effectively do is, there would be something to stop you from double dipping. So if you use certain wages to apply for PPP forgiveness, you wouldn't be able to use the same wages for the employee retention credit. So some have been saying, if this provision were to pass, then maybe you'd want to minimize your payroll costs for forgiveness, maximize the amount of utilities, and retroactively claim a credit against your payroll taxes. I know that there are still those advocating for an expansion of this credit. It wasn't in the version of the bill that I saw last week, so I don't know how long, whether this would still happen. Maybe if it does happen, it'll no longer be retroactive. It'll just be prospective, and then that's not a reason to hold on to the loan. But with both this point and any of the other points outlined here, these are all just pending changes. None of these have actually happened yet. Whether they eventually will happen or not, it's to be seen in the future. It's something to keep in mind, something to look for if anything does pass in the coming months. So that is the information there. I know we've run a little bit over, so I'm not going to jump on the Q&As here live on the webinar. We do have those recorded for us, so we'll take a look at those after this concludes. Feel free to email, reach out to any of us with any specific questions. You got some link resources here for any of the PPP guidance, the franchise code, and then that OCD.com link will have these slides, as well as if anyone's still using the forgiveness workbooks, like the Excel workbooks, we'll have an updated version of that there and this presentation. But otherwise, just to recap, get ready for the loan application process. See if you can meet it based on 100% payroll. If you can't otherwise meet it with your rents and other costs, start to look into getting, self-reviewing your information or having your advisor review it for you. Even if you plan on holding on to the application, waiting to actually submit, now might be a good time to start looking at that while it's still fresh on your mind. And then keep an eye out on deductibility of expenses. I think that'll be probably one of the hotter topic ones. Looking forward to see whether or not we can take those. But thank you for coming out on your Monday, talk about PPP. Talk to you soon, and thank you and have a great day.